Hi everyone, welcome back to Conarchy's Money Corner. This week I'm going to address an old mortgage program that has resurfaced again during these current rising interest rate environment. This is the 210 buydown, also known as the 2-1 buydown. We used to, back in the days, used to call it the 210 buydown, and I've seen a lot of places where they're just calling it the 2-1 buydown. So many mortgage loan officers and realtors have been recently promoting this program as mortgage interest rates have jumped. It's their attempt to turn back time and to show prospective home buyers and sellers the lower mortgage rate and therefore a lower mortgage payment. First things first, what is a 2-1 buydown? Simply put, it lowers the prevailing mortgage rate 2% the first year and 1% the second year. Therefore, your monthly payment will be lower the first 2 years, lower than what it would be if you would have just used the prevailing rate. So as an example here, if the prevailing rate today is 7%, you would have 5% year 1, 6% year 2, and then the prevailing rate 7% years 3 through 30, 210. So what is the impact when we do that? What's the impact, and with that rate reduction, how does it affect us? Well, then let's use an example here of a $350,000 mortgage amount. Your principal and interest payment at 5% would be $450 a month less than the prevailing rate. And at 6% year 2, $231 less a month for that second year. So that saves you $5,400 year 1 and $2,800 year 2. So far so good, right? Sounds interesting, huh? But wait. As I share this with you, I share with you what I always say on Conarchy's Money Corner when we look at these financial decisions. Look at them financially, not just the emotions of a lower rate and a lower payment or a lower payment. So let's go to the calculator. Let's do the math. Here is the secret of a 210 buydown. In order to save that money, $5,400 year 1, $2,800 year 2, for a total of $8,200, you have to come up with that $8,200 up front now. Yes, you heard that right. You have to pay $8,200 up front now at your mortgage closing to save $8,200 in those lower payments over the next 24 months. So a warning to everyone being sold a buydown out there today. A buydown does not save you any money. You were simply paying now to save that exact same amount later. And in the meantime, somebody else is holding on to your $8,200 that you paid up front. I believe in not giving my money away to anyone for the promise of getting that same amount paid back to me at a later date. No, thank you. I will keep my own money in my own hands. I don't need someone else holding my money, promising to give it back to me at a later date. What happens if they don't give it back to me? What happens if a month goes by and they don't show up and give that money back to me? No, thank you. Not going to do it. Now, I know some of the mortgage loan officers and realtors watching this are saying now, Ed, just have the seller of the house that the person's looking to buy, have them pay the $8,200 buydown costs for the buyers. Again, we need to do the math. We need to go to the calculator and see how this plays off. First things first, no seller is just going to give a buyer $8,200. And if that seller did agree to do that, no, you are paying $8,200 more in the sales price. Because, think about it, the seller would also have agreed to sell you that home for $8,200 less if you didn't ask them to pay the $8,200. Either way you cut it, you're paying for the $8,200. But what makes the seller paying the $8,200 in the form of the $8,200 sales price worse, it means that you will have to take on an $8,200 higher loan amount if you compare apples to apples. So now your loan goes from $350,000 that we used in the first example up to $358,200 now. The $8,200 higher loan amount raises your payments and lowers that savings that we used in the original example. Now your payment savings is only $406 a month with the higher loan amount year one and $181 year two, saving you now just $7,000 over the first 2 years. And even worse, your payment is $5,500 more when you go to the prevailing rate years 3 through 30 because of the higher loan amount. So taking on $8,200 higher in a loan amount to save $7,000 and then losing $650 a year moving forward years 3 through 30 is not financially produced decision to make. The math just doesn't work. What I recommend instead is you just take the prevailing rate, whatever they are now, without you or the seller paying thousands of dollars of upfront fees, and always get the lowest sales price from your seller. Then, when mortgage rates fall in the future, refinance to a lower rate and payment at that time. Each time when you buy the home and refinance, avoiding paying the thousands of dollars of upfront money to buy down the rate or buy down the payment. And if you say to me, Ed, I can't afford that higher payment using the current higher prevailing interest rates, then I say to you, you should not be buying that big of a home and taking on that big of a loan amount then. Buy a smaller home with a lower loan amount. Or simply wait. Wait to buy that bigger home until you can afford the payments. Just like a TV. Don't buy a TV you can't afford. Buy a TV that you can afford. Remember, you're still going to have to pay the higher payment at 7%, that prevailing rate, after the 24 months are up anyways. So the higher payment is coming one way or the other. I hope this explains the financial concerns I have with a 2-1 buydown. As the old saying goes, there's no such thing as a free lunch. There is always a catch. And the 2-1 buydown is no exception. Let me know what your thoughts are on this. Let me know what your questions are on this. Go ahead and comment in the YouTube comment section below, and I'll address those. As I always say, thank you for watching. And I'll talk to you next time on Conarchy's Money Corner.